Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky with Break of Day Capital. Be sure to join our Facebook group, Asset Management Mastery, where we have a great community of thousands of like-minded individuals sharing resources and best practices. Most investors rely on gut feelings, shiny brochures, or hype, and that's exactly how people miss red flags and lose money. At Break of Day Capital, we do things differently. We help investors make smarter decisions before the deal ever hits your inbox. From our educational webinars to our Invest Smart book to real tools like our portfolio tracker, we're here to give you the edge most investors don't even know they need. If you've been valuing our podcast and want to take the next step, subscribe to our newsletter. You'll get early access to webinars, new investor tools, and market insights sent straight to your inbox. Break of Day Capital, because smart investing starts before the deal.
Financial advisor Bromley Palamountain of Northwestern Mutual empowers people to make their financial dreams a reality through purpose, clarity, and design. Be sure to check out his links in the show notes. Today on the podcast, we have Kevin Kim. Kevin leads Fortra Law's corporate and securities practice. Kevin and his team have advised and prepared hundreds of security offerings, including mortgage funds, structured debt offerings, real estate syndications, crowdfunding offerings, EB5 projects, and qualified opportunity funds. I met Kevin where we were on a panel together at IMN's multifamily middle market in Scottsdale about a month ago. Thanks for joining us, Kevin. Can you start by telling the listeners a little bit more about yourself and what you do?
Yeah, thanks for having me on the show, Gary. Yeah, we're a real estate focused group. I work both in credit and in real estate investing. We primarily focus our securities practice in that arena, and so we work with both lenders and real estate investors / developers. So we run the gamut of different types of securities offerings. So your average real estate syndication to your offshore feeder fund with a master U.S. block, all that stuff. And then we also do REIT work and up and down the food chain in the real estate world. In the credit world, it's kind of the same thing. We do, advanced level structuring to your simple loan syndication. And because we play in both worlds of credit and equities, it gives us a little bit of a unique edge when it comes to understanding deal structuring. EB5, we do that. We did a lot of it when it was hot and heavy. It's kind of quiet right now, but it's making a comeback. Ozone, when it was busy, we did a little bit of that, but it's very quiet right now. We're expecting some return on that pretty soon. And so, yeah, that's kind of where we're at. We're as a firm. We're very, very well known in private credit. And we're upstart on the real estate side, trying to build our brand there.
Nice. So the story of the last couple of years in multifamily has been a struggle based on cap rate expansion, a big wave of new product, and higher interest rates longer than anyone expected. Mm-hmm. From a legal perspective, how have you been navigating this for your clients as far as dealing with investors, lenders?
Yeah. On the investor side, we've always been remarkably conservative in how our clients structure their offerings. So one of the biggest things is not only on the documentation and ensuring that they have the mechanisms to deal with any kind of fluctuations in the market, whether it be a capital call provision, whether it be, advising the client on making sure that the CapEx is adequately underwritten, not overextending themselves on the structure. We saw that a lot when rates were low. The very, I guess you can call them ambitious structures or ambitious raises. People are trying to go open-ended as opposed to closed-ended on the fund side. We try to make sure we take a very conservative approach in the structuring. Besides that, we play advisory beyond the fund, right? And so, or the syndication, we'll talk with the client with kind of what their plan is in the capital stack. And one of the scary things that we saw was not only with the rate fluctuations, but also I guess you can call it the lack of, I guess you can call it short-term financing. So you saw a lot of folks overextending themselves in leverage. And so we really tried to warn against that and try to advise the clients what the mechanisms are when it comes to these things. Because what we found was a lot of the real estate investors were they didn't quite understand what they were getting into, particularly revolving around pref equity as a means of subordinate financing. So we wanted to make sure they understood, because we, on the debt side, we structure those deals all the time. So we can walk them through. Here's the landmines when you're dealing with pref equity. Understand what you're doing here, because it's not your average second position lien, right? So those kind of things. We didn't expect rents to be this problematic for this long, and so it is a challenge still. But I find that it's gotten a lot better in the past year or so. It was a lot worse 3 years ago, 4 years ago. So I feel like it's getting better. And clients are starting to figure out how to make things work. I think they're going back to fundamentals, and that's been the real success stories these days. So,
well, it's probably better now, because now that we've suffered the pain and realized some of the mistakes we've had as far as over leverage, and when you're winning, when the cap rate is so low, and you're going after these deals, and so you need that leverage, and I mean, a lot of us shouldn't have been doing those deals in 2022,
right?
And certainly there's been a lot of syndicators that have lost deals, or still lose deals, and have had capital calls to survive. And it was survive till 25, and now it may be survive till 27.
Yeah, and the credit markets, they're feeling the same pains. Like, hey, and they made the mistakes too. Like, why weren't you evaluating their syndication documents for capital call provisions? Like, you need to make sure your borrower has that. And sponsors were not like, it was a 4-letter word, and back in 2012, capital calls were common, and it made sense, and it was understood that was kind of what the nature of the business is. It's something that might happen, and it's not a 4-letter word. So, we were spoiled for so long with such low rates, and I think that this is a realization of like, okay, let's go back to fundamentals, really good underwriting, and really be cautious in how we approach these, and also like temper investor expectations. Hey, a capital call might happen, right? It's an unknown universe out there. It's hard to predict a lot of unforeseen. And our friends in commercial real estate really took a beating, and I think that's taught a lot of folks some really important lessons.
Yeah. But now it's a great time to buy. You've got massive cap rate expansion.
Yeah, it's getting better.
Rates are still pretty reasonable. I know everyone is like got their fingers crossed for the rates to get lower and lower, but it's still really reasonable based on the numbers. So
perm financing is starting to come back, and it's starting to look a little better out there. I don't know that and in the credit world, the lenders are complaining because they're saying there's too much capital out there. So it's a good time if you're a borrower, because quality deals will get VIP treatment.
I think a lot of syndicators don't know all the different nuances and intricacies that could happen, but maybe talk through one of your more intricate deals you've had to close in the last year or so.
Well, so I guess you can call it a deal. It's really more of it was a fun project that we borrowed from our friends in residential, 1 to 4 family, and applied it into commercial real estate, mostly in multifamily. Another client did it in industrial, and we really liked the idea of it. It was kind of it was the best of both worlds, in the idea of syndication and fund, and kind of wrapped into one, using the Series LLC model. And we did it both through crowdfunding and under Reg D. And that was a really interesting project, because we were able to translate, and multifamily particularly, there's a lot more sensitivity deal by deal, whereas in 1 to 4 family, they're pretty cookie cutter, right? So you were able to translate the syndication model to a fund structure, which is very useful for a client when it comes to his needs in operating, right? Now that, it was hard to find good deals, so it kind of was structurally, not many series got stood up after the first 2. Another interesting file that we had this past year was a client was a multifamily developer, value add, and forming asset acquisition strategy, and they had opened a channel to raise capital overseas, and primarily through South America. And there was a lot of demand down there to invest and also because of capital flight, to park their money in a stable asset, comparatively speaking. Obviously, there's no such thing as a stable asset, but comparative to their local economy, right? So, so a lot of money coming out of Argentina and other pockets of South America, and we had to build a offshore structure for them to accommodate the tax issues. So that was kind of a great project to do, because we've been doing that for years in credit, and we noticed there wasn't as much of a attraction to it anymore in real estate, but it was good. It was a good sign that it's coming back in our world, and there's a lot more interest with overseas capital, and we've had a couple more consults in that arena, so we're excited to push that product a little more. So
nice, yeah. We on 3 of our deals, we got a good amount of capital from a South American country. They had some unrest, and so they're looking to park some money in the U.S. They already had the structure in place, and they've been a phenomenal partner for us.
Right, and it's really just a tax issue, right? So it's not too hard to navigate with the right team. So
in your bio, we talked about EB-5 visas, and I was shocked to see almost 15,000 EB-5 visas were issued in 2024, and over 9,000 came from China. First off, explain to our listeners what it is, and what do you see like the best use case for that in real estate?
Yeah, I mean, EB-5 was huge during probably the 2009 up until 2017, 16, 17. The program it's an immigration program, and it was designed around, okay, well, if a wealthy foreign national were to invest in a U.S. business that created jobs, then we should reward them and offer them a means to get a green card here. And so that's the fundamental thesis around EB-5. It's EB stands for employment based, right? So it's employment based visas for a green card, and it was kind of the one way to raise money around immigration. And so there's a couple of different ways, but that was the primary way. So in real estate, it became immensely useful because it's a very low cost of capital, because the investors are not coming to this with the desire for a high yield return. They're looking for a green card, right? And so the cost of capital was low, but it needed to create jobs. We saw a lot of EB-5 being used in ground up construction projects in hotel, in industrial, multifamily, commercial real estate in general, because those types of developments created so many jobs, not just directly, but indirectly. The program went through its woes because there's always going to be some bad actors, and it's been reformed recently, and so that we're waiting on some updated rules. But what's interesting is the market's evolved. What used to be used as a means of subordinate financing for a developer, for a ground up construction developer, usually, where the sponsor or a professional EB-5 program would raise the money and deploy it via mezz financing or as prefac behind the senior construction financing. Oftentimes it was the sponsor themselves, right? The developer would hear about this, learn about this, and they would do it, and they would syndicate their own debt effectively, right? And do it through means of EB-5 investors to bring low costs of mezz financing to their project. Today, the market's evolved a bit, where I think that because of that risk and the current state of the market, EB-5 has transitioned to more of a senior financing product, where they're looking for small deals, direct deals, more in rural areas because those get preferential treatment, and direct first trust deed position type loans, but still at a low cost of capital, comparatively speaking. That we're looking at, interest rates of sub 10%, which is fantastic in today's market. And it's longer term, right? So it's not a 1 year, it's not a 12-year thing, because the processing time takes a long time. So it can be a 3-year thing, a 5-year thing, depending on the program. So it's still useful. It's not really completely fleshed out right now because of the new rules coming in, but it's still being used in very small pockets. It was a huge, subset of the kind of commercial real estate market in the finance world. It's starting to make it come back slowly, and I think it's whenever rates create volatility, it's a good alternative to look at. There just needs to be reform around how the visas get issued, because there's a huge backlog, and also everything's up in the air with the Trump administration. We don't know exactly what the impact of the Trump card is going to be, because that might just blow EB-5 out of the water, because the difference between the investment amounts is not a lot. I believe the Trump card is like $1 million or something like that, whereas EB5 is usually $800,000. So it's like it's not a meaningful delta for a very wealthy individual overseas. So we're not entirely sure how that's going to play out, but we have had conversations with developers lately who are interested coming back. EB5 is back. Can we start thinking about this? And we're looking at it with them. But the problem is that the market is shifting toward all the inquiries nowadays are more of a lender's perspective. I want to be a first position lender. So that's kind of the way the market's shifting right now.
Yeah, I was hoping it would be more on the LP side of things versus like a mezz or even first position.
Yeah, I mean that's always been there, but it's more of what we call a direct deal, right? So EB5 will always be a valuable tool for direct investments like that, but that would require a single project that can directly create the jobs, not indirectly create the jobs. But it's out there, yeah, that can be used as well.
Right.
But right now it's geared toward more rural projects. I think rural projects are probably the highest likelihood of success because they get preferential treatment.
Okay, good to know. When we were on the panel together, you mentioned an UPREIT as a solution for some of these deals that have struggled. Mm-hmm. Walk the listeners through what an UPREIT is and how you take it.
It has to partially do with the lack of permanent financing and the lack of liquidity on the takeout for someone who's doing value add. What we've noticed was that combined with a strange glut of tax deferred money coming out to the market too. So the client needs to figure out what to do with their properties because they can't rely on selling them anymore. And permanent financing is kind of hard to qualify for nowadays on a one-off basis. So what's been part of the conversation is to do a roll-up, right? So we would take either a bunch of syndications or small funds. They got all these properties. You can contribute those into a operating company that's owned by a REIT. And we call that an UPREIT, right? And effectively what happens is by contributing the properties, you're not necessarily creating a capital event because you're contributing them in exchange for units. So think of it as a takeout vehicle where you contribute the properties instead of buying the properties almost, right? So, and you're still operating this separate REIT, right? And you're going to contribute those properties into the operating company. And then those will be exchanged for REIT units in the long term. And so that creates some tax efficiency for the investors. But for the sponsor, it creates an opportunity for us to basically create a vehicle that can be our buyer and raise money into that. This alongside with, when rates were really low, DSTs were all the rage. And so, all cash DSTs are still popular. So these are ideas of utilizing the tax code to solve a problem effectively, right? And REITs now get preferential tax treatment because the One Big Beautiful Bill Act made the 199A deduction permanent. And so now you have layered benefits, right? REITs in general don't pay taxes because it distributes all its income. But on top of that, a 20% pass-through exists. So there's a lot of additional benefits to the investors. It's not really ideal for something that's kind of mid-construction, right? I would probably say stabilized properties where the sponsor is finding it difficult, or maybe the sponsor may not desire to sell the property right now. And they have a bunch of different syndications where these structures are not conducive to long-term holds. Let's create a long-term hold and not necessarily create a capital event for everybody. And so that's something where you can bring those guys along for the ride for a stabilized strategy. Another thing the clients have been doing in lieu of, because this is a little more complicated, it's got layered tax issues. You need very sophisticated tax professionals on top of, a very experienced securities attorney in the REIT world. There are other strategies that are kind of similar in the context of can we think about adjusting our syndications and amending them for long-term hold? The idea here is just purely around, listen, I don't want to sell these things right now. I'm going to take a bath if I sell this. Investors are probably okay with sticking around for a little bit longer of a hold. Let's add a crystallizing event into these syndications, amend them, get a vote done. It's also another idea. If your pain point is simply just long-term hold issues, but if your pain point is also maybe the taxes, that might be a more efficient choice. And was primarily done, at the institutional level, and is very much seen a comeback at the middle market level. We see a lot of sponsors entertaining the idea because they're kind of in this weird limbo, and it also makes financing a lot easier because you've got a portfolio of properties, right? So it makes permanent financing a lot more attractive to a portfolio lender, as opposed to one-off permanent transactions.
Can you make it a capital event? Because if you do that, then you can do a whole nother cost segregation study.
Yeah, so that would just be a non-UPREIT type situation with no contributions, where we do this a lot for sponsors where they have like a permanent vehicle that may choose to be a REIT, right? But it's not a contribution event. What happens there is they just buy it they just buy it, right? So they have a negotiated price, or we disclose it in the syndication and say, hey, we have a vehicle over here. It's willing to buy it at this valuation, compared to having to put this on market and sell it, for God knows how long it's going to take. This is the right move. We're going to sell it. Usually the syndication documents have that authority in the sponsor. They'll sell it and they'll create the capital event, right? And so that allows any minor adjustments to be done to the properties to get some more cost seg and more depreciation. And the investors in that strategy are going to be much more looking at this from a long-term hold, maybe lower rate of return, income-based, cash flow-based. And if the assets are all rental properties, then you can turn it into a REIT if you want to, but you would have it buy the properties instead. And that's totally fine, right? It's not the same thing as traditionally we think about in a roll-up REIT situation, because you're contributing and you're trying to avoid that capital event. So it really much depends on what your motivations are.
Right. So how do you see the business side evolve from legally over the next few years? And I was at a multifamily mastermind maybe a month ago, and people were talking about, they take existing PPMs and load it into AI, and then from there they send it to the lawyer to like fine tune it and whatnot. But obviously, people are doing a lot more on their own, which can be dangerous, obviously. But how do you see things evolving?
Well, I'm not going to poo-poo AI completely, right? Because then, I use it, right? So I use it for a lot of like agent work and that kind of stuff. I would say that the problem with AI to amend your PPM is that oftentimes AI does not rationalize whether or not this is a material change. If you need to deal with a voting issue, it doesn't really know what to do there. And also, like from a disclosure package standpoint, there are nuanced material risks when it comes to, like, if you're going to amend, especially amending typically requires a vote of your LPs. There's some nuance in that, right? Because you also want to think about not the immediate need. You kind of want to think about, well, what's my what might be my 3-year need? So there's a little bit of a nuance there. Also, what we've noticed is that it fails to disclose the nuance of any kind of financing that might be coming in. And so that's another thing. But yeah, I mean, listen, margins are tough right now, right? So I'm not going to say sponsors, you can try your hand at that. GPT-5 is pretty damn impressive, but definitely have an attorney, spend some time with it. When we do amendments, we just go by the hour. So it's not that much. I mean, if you want, and it traditionally it's been sponsored, marks it up, and we go in there and make the cleanup. So I'm not opposed to the idea. I would just be cautious that don't just do it without an attorney. We've seen a lot of nuances that can just snowball into this massive problem. But yeah, I'd say legally speaking, like I said when we started, right? Going back to fundamentals, that's going to be important. I know real estate sponsors love the idea of open-ended funds. I'm not a big believer in that right now for real estate. It creates way too much wiggle room, and it creates way too much room for funny business. And I would rather you be very, very kind of narrow and disciplined about how you approach things. And that keeps everyone honest, and also it gives the investor certainty. There's no funny business in valuation, and that's where a lot of the investor disputes have happened over the past 5 years. And so we don't want to see headaches when it comes to valuation. We also don't want the sponsor to have to deal with a liquidity fight. So, closed-ended is the move. I don't think, for the time being, at least. It can be done on an open-ended basis, but it's a lot more nuanced and complicated than you think. You have to really think about the liquidity plan and also the valuation issues. I bring this up a lot. I like the series fund structure for all types of real estate investors because it gives the sponsor the benefit of I can basically go deal by deal, but then not have to go to legal every time, right? So because since Series LLC, you just need a 2-page disclosure to add on to your master PPM. So that gives you a lot more benefit from a structure standpoint. I expect more and more sponsors to really utilize probably go back to. I think that Regulation D and Regulation A are due for some minor changes over the next year or so with a lot of this deregulation coming, and I think it's going to attract more sponsors to use those things. Reg A is not very widely used in multifamily. I think it's a very useful tool if you're willing to invest in that strategy. It's a public offering, right? And then aside from that, I think that from a legal standpoint, we're probably going to see a lot more clients go back to kind of small deals, small raises. I've noticed that as a trend since last year is like instead the guy that would normally do a full on syndication and raise money from 50 LPs is going to do 5 big tickets and just do a very straightforward structure. And I don't think JVs are going to go away either. So I think I think that's going to be a consistent theme for the next year or so because it's still really competitive out there and very challenging. So.
And sponsors are struggling the last few years to put together, the cap stack. A lot less leverage, and investors have been burned by some syndications. Not a ton, but the stock market performing so well. Bitcoin up to a point was performing super well. Gold, silver. So there's a lot of competition for investors' money. And there's a ton of dry powder sitting on the sideline waiting for these opportunities, and people are trying to time the bottom. And they won't know the bottom until 6 months after we've already hit it.
And I warn investors when it comes to that. I get this all the time from investors that we meet, like, we want to take advantage of the opportunistic opportunity. I'm like, you have to understand that institutional money got wise the last recession, and they have been building massive machines to acquire anything distressed. So like what was once something you could easily get from a broker, a tape of loans from a bank that's in distress, and it was easy to do. Not so much anymore. The biggest distress and net debt buyers are really consolidated. There's a lot of big outfits that do this professionally, and they've had 15 years, almost 20 years now to perfect the machine, right? And that machine is massive because it is a very profitable investment. And so to say that, hey, I'm going to wait for the really big windfall opportunities, I just don't know that you're going to find it if you're you're a high net worth investor, right? Because you have to compete against PIMCO, and PIMCO, they're not going to lose deals to you. They're not worried about you, right? So, yeah.
We've definitely been in some best and finals, and people that have had a massive war chest have beaten us pretty much every single time. We did win, but because we had tremendous broker relationship. But the big purse will always win.
And there's a large war chest that loves the distress, and they're patient. They have patient capital.
Well, Kevin, thank you so much for coming on the podcast and sharing your expertise. Please tell the listeners where they can find out more about you and your company.
Yeah, you can find us on our website, fortralaw.com. You can also email me, k.kim@fortralaw.com. And we're all over the internet. We got YouTube. So just search us on YouTube. We're on Spotify for our podcast. More on the credit side, but you can find us there too.
Awesome. Thanks so much. This is Gary Lipsky signing off. I'll be back next week with another informative episode on the Real Estate Investor Podcast.
Thank you for having me.
To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.